When you first look at a stock chart, it can seem like just total chaos, right? A bunch of random squiggles. But every now and then, a clear story starts to take shape. Today, we're going to talk about one of those stories, the descending broadening wedge. Now, this thing is fascinating because it's like watching a fierce battle play out between buyers and sellers. And if you know how to read it, it can give you a pretty serious edge. So let's break it down, what it is, and more importantly, how to spot it.
Okay, let's dive right in and get a good look at this thing. The easiest way to think about it is, well, it looks like a megaphone that's tilted down. See that? You've got these two lines and they're both sloping downwards, but they're also getting wider and wider apart. That widening shape is everything. It's telling us that the price swings are getting bigger, more dramatic. What traders call increasing volatility. It's basically a big flashing sign that there's a ton of indecision in the market.
All right, so here's the game plan for today. First up, we're going to decode what this whole megaphone shape is really telling us. Then I'll walk you through the exact rules you need to know to spot it correctly. After that, we'll zero in on the most crucial moment, the breakout, and we'll actually look at the stats to see what usually happens. And to finish things off, we're going to pull it all together into a simple step-by-step trading strategy.
Okay, let's kick things off with section 1. What is this downward tilted megaphone actually telling us? I mean, what's going on with the market psychology here?
So what you're really looking at here is a classic tug of war. The overall trend, yeah, it's heading down. The sellers are pushing and pushing, making new lows, and that's what forms that bottom trend line. But here's where it gets interesting. Look closer. Every time the price bounces, the buyers fight back even harder. They create these peaks that are actually higher than the previous peak inside the pattern. And that escalating fight is exactly what creates the widening shape and all that tension building up in the market.
Okay, now this pattern has, well, it's got a fascinating split personality. Take a look at the image on the left. Here, it's acting as a continuation pattern. What that means is the stock was already going up, it took a little pause to form this wedge, and then boom, it continued right on its original upward path. But now look at the one on the right. This is a reversal pattern. The stock was in a clear downtrend, and this wedge forms right at the bottom, marking the exact point where the price completely reversed and started shooting up. So because this one pattern can lead to two totally different outcomes, you can see why identifying it correctly is so important. You definitely don't want to mistake it for something else. Which brings us perfectly into our next section, the official rules for spotting one of these things out in the wild.
All right, let's run through the checklist. First, you've got to have that downward tilted megaphone shape. That's non-negotiable. And here's a key detail. The bottom trend line has to be steeper than the top one. That's what gives it that broadening effect. Next, and this is to make sure the pattern is for real, the price has to touch the top line at least twice, and the bottom line at least twice. That's how you know both buyers and sellers are actually respecting these lines. Something else to watch for is volume, the number of shares being traded. It usually starts to pick up as the pattern forms, which tells you more and more people are jumping into the fight. And finally, as we already know, that breakout can go in either direction.
And here's a perfect visual of that touches rule. You can literally see it. The price goes up, hits the top line, sells off, then comes down and hits the bottom line. To be a valid pattern, you need that to happen at least twice on the top and twice on the bottom. Really, just think of it as confirmation. It proves you haven't just drawn some random lines on a chart. These are actual boundaries the market is paying attention to. Which brings us to section 3. And this is the moment every single trader is waiting for, the breakout. So what is a breakout? It's simply when the price finally escapes the pattern, when it closes decisively above that top line or below the bottom one. This is the big signal. It tells you the tug of war is officially over and one side has finally won.
So you've done all the hard work, right? You've identified the pattern, you can see the tension building up. The million-dollar question now is, what's going to happen next? Is it going to break up or is it going to break down?
So what does the actual data tell us? Well, it shows that this pattern acts as a reversal about 55% of the time. So if a stock was heading down before it formed the wedge, there's a 55% chance it's going to break out to the upside. Now, that's a small edge for sure, but with a 45% chance of it continuing down, that's basically a coin toss. You absolutely cannot just blindly bet on a reversal every single time. But, and this is a big but, there is a very powerful clue we can look for. It's called a partial decline. Take a look at the chart. See how the price starts to drop from the top line, but it doesn't quite make it all the way down to the bottom line before it turns back up?
That's it. That's a huge sign of weakness from the sellers. It means the buyers are getting impatient. They're jumping in sooner and with a lot more conviction. And check this out. Here's the killer stat. In a bull market, when the overall market is trending up, a partial decline like this predicts an upward breakout a stunning 87% of the time.
I mean, 87%. That just shows you how powerful looking at the data can be. So let's dig even deeper into the stats. Let's go beyond just which direction it's going to go. How big of a move can we actually expect? And maybe even more importantly, what are the chances that the whole thing just fail?
Okay, this is where it gets really, really interesting. The data is crystal clear on this. Trading with the overall market trend pays off big time. So in a bull market, when everything's generally going up, an upward breakout from one of these wedges leads to an average gain of 33%. On the flip side, in a bear market when things are going down, a downward breakout averages a 25% drop. I mean, these are not small moves we're talking about.
But of course, no pattern is perfect, right? Nothing works 100% of the time. The most important question for any trader is always about managing your risk. So let's ask it, what's the failure rate? And the answer is, well, it's surprisingly low. The data shows what's called a break-even failure rate of just 6% for upward breakouts in a bull market. Now, what does that mean? It means that only 6% of these breakouts fail to gain at least 5% before they turn around and fall back down. To put it really simply, your chances of getting out of the trade without losing money are super high. And that's exactly the kind of edge a trader is looking for.
Okay, but before we get too excited, let's bring it back to reality with this quote from the source material. It's such a great reminder. Remember, the overall reversal rate is only 55%. That's just a little better than a coin toss. So you can't just expect it to reverse. The big takeaway here is you have to wait for the breakout to confirm which way it's going. Don't try to be a hero and predict it.
And here is a textbook example of what a failure looks like. See that? The price breaks out to the upside, which looks like a buy signal, but it runs out of steam almost immediately and reverses course. It even comes back down for what's called a throwback. It retests the trend line it just broke through. And when that test fails, the price just collapses. This is a perfect example of why traders always use a stop loss. It's an automatic sell order that gets you out if the price drops, protecting you from these kinds of big losses when a trade goes south. All right, we have covered how to spot the pattern. We've dug into the statistics. So that brings us to our final and maybe the most practical section. How do we turn all of this knowledge into a real, actionable trading plan?
It all boils down to a pretty simple 4-step process. Step 1 is easy. Identify the pattern using that checklist we went over. Step 2, wait. And honestly, this can be the hardest part. You have to resist the urge to predict. You wait for the price to actually close outside the trend lines. That's your confirmation. Step 3, set a price target. A really common way to do this is to aim for the highest price that was reached inside the wedge. And last but not least, step 4, protect yourself. Always set a stop-loss order. That's what gets you out with a small loss if the trade immediately turns against you.
Now, if you really want to tilt the odds in your favor, here's a little cheat sheet right from the research. First, always trade with the bigger trend. Go long in a bull market, short in a bear. Second, look for tall patterns. The bigger the pattern, the bigger the potential move. Also, if you see a price gap on the breakout day, that is a super strong positive sign. Be a little wary if you see a throwback. They often hurt performance. And of course, remember our little secret weapon? That partial decline is your absolute best friend when you're looking for an upward breakout.
And there you have it. We've taken what seems like a really complex chart pattern, broken it down into a simple megaphone shape. We've figured out its split personality. We've crunched the numbers on how it performs, and we've even built a little playbook for trading it. So the only question left is for you. Now that you have all this knowledge, how is it going to change the way you look at a chart the next time you see one of these patterns starting to form?